Okay, hello everyone. This is my second time recording this because I just realized I talked for 20 minutes and it was not recording audio for some reason. Before we start, just a couple housekeeping things. I realized that last time when I uploaded the link into the bottom of the Instagram description, apparently it doesn't actually work. So from now on, I will be uploading all of them to YouTube so you can you can play on 2x speed and all that good stuff, but I will include the link in the bio of like the actual profile so it's easy to find and easy to access. So I really hope this recording works, but this week's topic is on portfolio management. So we're going to talk about why we diversify within a portfolio. We're going to talk about sizing, so how many positions, is ideal, and what the percentages should look like within the portfolio. And then we'll talk about risk management, so the different kinds of risks, because there are a couple. And then we will do a real life review, so we can look at my portfolio and see how it's constructed and the different sectors and essentially what I've chosen to do to minimize risk. So to start off, why do we diversify? We mainly diversify to limit risk. So in a perfect world where we have information, right? You would just put all your money into one thing, right? And then, because there's no reason to, you could even leverage yourself 50x, and then, because it's a sure thing, right? But in reality, that's not the case, because we're basically, it's just like a big casino, but we want to we want to be more right than we are wrong. And as long as we can maintain that, even if we're winning only 51% of the time, over time, you'll still make money because it's calculated. It's essentially calculated gambling is how you should think of it, which is why you never want to get, too hot-headed and think, you're like a god or something and, you put all your money into one position, because that's a great way to start from zero, which is something you really do not want to do when you're investing, right? Because they always say the first 100,000, the first million, the first billion is always the hardest, right? Because it is. It's really hard to start with nothing, and because the majority of your gains will be from contributions, right? And then another reason why we diversify is to reduce the volatility within the portfolio. So while volatility is not necessarily bad, it can be, it can be pretty stressful to some people seeing your portfolio fluctuate on like a large basis. So back in 2018, when the only position I had was Tesla, my portfolio would really like swing within like, good earnings up 20, bad earnings down 20, which was fine, right? Because like that wouldn't really be considered a portfolio with only one stock. But once you get into like larger portfolio figures, like, hypothetically, if your portfolio was $10 million, you would not want all of it to be into one position, right? Because like, you wake up, it's like, I'm down 1 million today, I'm up like 2 million tomorrow. That's really bad for your mental health and your stress levels. We know humans don't operate well under extreme stress, so that's part of the reason why we tried to reduce volatility within the portfolio. Next, as far as position sizing goes, you don't want too many positions because then you essentially just become an ETF. And if you're going to do that, you might as well just buy an index fund, right? Because it's just way simpler. Personally, I don't think you realistically have any reason to have over 30 positions. That's just way too many, unless you have like a team working for you. But then, I don't know. Yeah, probably not above 30. And then you also don't want too few positions, right? Because then you're really betting like all your marbles on just those few companies or whatever, crypto or housing or whatever, right? Because you don't want to be too overexposed to any company, any sector, because that like opens you up to a lot of risk in that sense. So obviously that's different when you're starting off, right? So for when I started, my broker was Questrade. The minimum account size was $1,000. So in that case, I just had two positions, so 500 in each position. Personally, I would not have like less than a $500 position since commission's $5. So right off the bat, you lose like 1%, right? So you don't want to be paying too much of your actual position size on like fees and stuff, because that's obviously not ideal, but you also want to try and get as diversified as possible with what you have. And when you're first starting off, there's nothing wrong with being like more concentrated, but as you add more money to your account, as your positions gain in size, it'd be good to start like diversifying more and more out to just get more and more positions, right? Because you can always increase their sizing later on. As far as risk management goes, so a lot of people, when they say like, oh, investing is risky or this is risky, you really have to you really have to understand what like risk means, right? So if risk is losing all your money, well then spreading out your positions within a portfolio to different companies, different sectors, that would be good risk management, right? So in an example, right, you could you could so say if you put all your money into one company, right, and then it doubled, so your account would be like this, it doubles, right, and then you do it again and it doubles again and then it doubles again. All you have to do, you have to be wrong one time, right? And if you're investing over a 10, 20, 30-year horizon, you're going to be wrong at least once, okay? I guarantee that. So knowing that, all you have to be is wrong once. This is not like, a math test. You got like one question wrong. If you're wrong and all your marbles in one basket, you start from zero. So that's something we really don't want to see. In another example, say if you had 10 positions, right? And somehow you picked a dud and one position went to zero. They somehow went bankrupt. You lost 10% of your capital, which obviously not ideal, but it is certainly recoverable, right? Because like assuming, you're picking good companies, the market is in a structural bull run, and even if one company does really bad, I don't know, something happens, they're exposed for fraud, your other 9 companies, the gains you make on those should more than cover what happened with one of your positions, which wouldn't be the case if you over allocated to like 1 or 2 companies, right? And something happened to that. As far as risk management, there's a couple different kinds of risk. So you have like individual company risk. So like within one company, there could be risk within like management. So like management's not doing well. It could be something happens to like, their building blows up, or no one wants to buy stuff from them anymore. So you have that kind of risk. You also have sector risk. So one sector would be, say, like banking, airlines, auto, what else? Like crypto, real estate. Those would all be sectors. So you would not really be diversified if you owned like, say, 10 banks, right? Even although you're diversifying your individual risk between the banks, you're still like not diversified at all from sector risk. So if something happened, like in 2008, financial companies really didn't do well. Oil companies have really not done well in the past 10 years, right? You want to not be too overexposed to one certain sector. That is essentially how you diversify out of it. And then for the majority of the world, right, usually when people invest, you're investing in like US companies, right? Because that's where most companies are listed. And with that comes currency risk. So say, for example, I have to convert Canadian dollars to USD and then to buy US listed companies. So there's a certain currency risk that comes with that. So say all of your positions could be going up, but you only own US companies. Even although your positions are going up, maybe like the CAD is weakening against USD. So you would be losing money on that front, right? There's also that risk to take into account, but it's not something I personally would be too worried about because that's like a whole different thing. And obviously, like say if you lived in Venezuela and you only owned US companies and things got really bad, you could always just like, I don't know, move to the US or move to somewhere where they accept USD instead of like trying to convert your money back. Although I think that might be the opposite. So disregard that point. But you know what I'm saying, essentially. Okay. As far as the real life review, we can have a look at my portfolio. Edit. Markup. So this is my portfolio. I've tried my best to diversify between a bunch of different sectors. So we can see I have some positions in crypto. I have some in, so like reopening plays. So we have Dave & Buster's, Southwest Airlines. I would count Fiserv in that. Also have oil and gas. So Transocean. Where is it? Suncor. So all of these would represent different sectors, right? So there is crypto, there is oil and gas, there is reopening. So all of these would be the same like outlook of a certain sector, but diversified between different positions. So say if, oil goes up, but you can like, so say if you want to play oil, right? You think oil's gonna be higher than it was a few years ago. You could either buy crude oil, which like typically you don't really want to buy commodities. It's just not something that people usually do. But you could do that. You could buy Transocean, rig, or you could buy Suncor, you could buy ExxonMobil, there's a variety of companies, but all of those would be different. Essentially, they would be all the same outlook for like one sector, right? And then in my case, I would be diversifying the one outlook with two different companies. So if something bad happened at, say, Suncor, and they went bankrupt, I would still be diversified because I would own two companies within one sector. And obviously, if I'm invested in that sector, I have like I'm hoping for a good outlook for that sector, right? That would be an example of diversifying within sectors. And then, yeah, I try not to have too many, as far as where I'm at, I don't really like to have positions over 10%. So see, my biggest one right now is 9.5. I don't really like to have positions less than 1% either. So my smallest actual position, I would say, is Zillow. And that's just because I just started buying in, just starting to build out a position. And I'm like very okay with being a little bit early and just being underwater for a few months because I'd rather that, and it doesn't really bother me versus, trying to time out the very, very bottom, because people always say, like you can't time the market. I disagree. I think you can time the market to a certain extent, but as far as like trying to pick absolute tops and absolute bottoms, I would say that's impossible, at least effectively. Although that's kind of funny because if you see, I recently just took a position on Solana and my cost basis is 212. So I think I might have caught the absolute top very recently. But Obviously, it's kind of what I expected. That's why I only put, like 0.3% of the portfolio in Solana. And current, I'm waiting for it to get to around like maybe 80, and I would scale in just a little bit more, but that would be a very speculative position. So I would not build that up very high. On that note, we also have, you also want to diversify in the sense of, because some positions that you would have would be like have really good valuations. Some would have like, high valuations. So you never really want to have positions that are very volatile or very speculative as like your big anchor positions. So my biggest positions are all companies that are making money. They're relatively undervalued as far as like traditional financial undervaluation. And yeah, like you see. So my biggest positions are obviously other than Bitcoin, but that's for another day. I have Discovery, Dropbox, Micron. Those are my three biggest positions by percentage, and they are all solid, stable, mid-cap businesses. So like in the tens of billions of dollars. It's not like I would not have Nano Dimensions. I would not have CleanSpark. I would not even have Rig, although it's like it's kind of high, but whatever. I would not have like Solana as one of my biggest positions because those are just like they're essentially just bets, kind of, right? They're calculated, but I'm less confident, and for a good reason. But yeah, I think that's all I have to say on portfolio management. Hopefully the sound records this time, and hopefully this makes somewhat sense. If you guys are confused about anything that was said, feel free to like send me a message. I will reply, and there's no stupid questions, right? But yeah, thanks.